Hi everyone, good morning. My name is Nick. I'm CEO and co-founder of KASKO. And today I'd like to walk you through some thoughts we have around collaboration of carriers with Insurtech or other partners. Maybe before I jump into it, 2 or 3 words about us as a company, so to show you where we believe we've gained some insights over the last 4 years around collaboration. At KASKO, we help insurance companies to create digital products and integrate them into their various digital partnerships, distribution channels, or other third-party providers. And 16 carrier relationships, 35 products, and over 500 distributor relationships after, we've seen some, let's say, patterns on how collaboration works or doesn't work. But this talk is not about us, it's more about what we've learned around collaboration. So, starting from the demand side, I think you've got to be pretty blind or ignorant not to see ample opportunity in the marketplace. You see changing customer behavior, new technologies, new data, digital access, a maelstrom of opportunities that arise in the marketplace. Now, you're not the only ones as a carrier who sees this opportunity. So what has happened over the last 4 to 5 years, a lot of new entrants have entered the market because they thought, ooh, there's so much opportunity in there, and maybe we can take their lunch. So one of these aspects is Insurtech. So these are VCs who invest heavily into Insurtechs. Now, don't get too hung up on the number. I just picked the largest number. I'm not even sure whether it's dollars or euros or pounds. You know, you get all these different consultancy papers just to say it's a big number. And compare that on how you invest really into new opportunities, not investing into your existing infrastructure. There's big money being bet on startups gaining customer trust and distribution faster than insurance carriers upping their game on targeting these new opportunities. You have new digital distributors or digital players. Again, I've just taken the obvious one, you know, Amazon, 100 million prime customers. They're going into smart home. They're starting to offer not just gadget insurance, but home insurance. So some, if you're a personal lines insurance carrier, they're starting to eat into your core revenues. I don't think they're going to start selling motor insurance anytime soon or life insurance, but they're eating your way in. And Amazon has a history of coming back and again. If you look at their payments, they started 10 years ago, didn't work. They just keep at it. And don't worry too much about Facebook or Google. Amazon works at really low margins. The other guys really don't. Another one is Revolute. Right? It's just the best funded neobank, and they're saying with 336 million in total funding, they're claiming to get 100 million customers worldwide, I think over the next 5 years. Whether that actually happens remains to be seen, but let's take they get 30 or 40, and these are now the gateways for you to access your customers. And then you have existing traditional distribution, brokers, agents, very different by market, but this is a recent funding round from WeFox, I think 2 weeks ago they raised another 110, so they now have 160 million in their war chest to digitalize brokers. Now what that means, you can now go, you don't have to, but you can now go through WeFox to access large amounts of distribution, but just having a great product in terms of great tariffs, great wording, is not enough to play here. Now, and this is a bit provocative, right? I think I would probably, if I read this morning, I would probably are struggling or could keep up their game or up their game on keeping pace with the market. But, you know, it's written there, so for the sake of argument, insurers are unable. And this is one of the reasons. So the status quo of insurance companies is there's really no IT capacity to try new stuff. And it's no one's fault, really. Existing solutions are expensive. They need to, you know, be maintained. But they're not really geared towards flexible, open systems to follow these opportunities, not all of which will reap similar returns. To me, this is a key thing. It's around governance. And to me, this is when I talk to my friends, they say, of course, insurance is really traditional, really risk averse, so this doesn't seem like news to them. Now, if you kind of look at what insurance does, it's portfolio, it's uncertainty, risk management. So to me, it's actually really counterintuitive if you go back to what the core of insurance is taking risks. Following opportunities is the same thing. You take risks. So instead of talking about business case and ROI on the initial phases, why don't you start thinking in bets? And not every bet will pan out the same way. But to me, this is, again, surprising. And the focus here is digital. We work with insurance companies, and there is so much talent out there, right, at the core functions of insurance. But if you're looking for digital talent, and these are, digital marketing, customer experience, developers, you're competing against startups, the big technology firms, banks, defense. Now, I'm not a big NSA fan, but if I was a developer, I'm sure that's a pretty cool gig. And might be a little bit cooler than upgrading your core policy systems. I'm just saying it's difficult to attract talent, and even if you get them, to keep those gals and guys enough room to actually do something. Because if you're used to kind of say, let's iterate, let's go out, let's get data, and not saying, why don't we now spend 6 months debating a PowerPoint presentation and some Excels in a boardroom, you might actually lose those that you've already managed to attract. So for the sake of argument, let's say make is not the best option. Then you still have buy or partner. And by buy, in this case, I don't mean buy services, I mean outright buying your suppliers. Now, the issues that I have with buy is, who do you buy? Who even is in the market? And again, let me play a little bit of devil's advocate. If you're a startup founder and you're looking to be acquired, you kind of see the end of the road there. So you have some form of negative selection. Now, whether, this example, I think Groupon got offered like 5 billion from Google, and they said no, they probably should have taken that money in hindsight. But I think it's really hard to spot which partner to buy, and as soon as you integrate them, you'll kind of make it really difficult for them to keep the solution because you want to keep it at your own IP. Not to talk about price. I think insurance companies are really good at buying portfolios, merging, pricing these things. How do you price a startup or vendor? And the integration, not so much technically, but around culture. I haven't looked up the latest statistics, but I think M&A is one of the most shareholder devastating activities that you can do, because it usually, whatever McKinsey and BCG modeled out, usually don't take place when it hits the actual people. People leave, usually the best people leave, etc. So what are the benefits to partner? And don't get me wrong, this is, it's an oversimplification of these models, but I think, first of all, it's low cost. It doesn't really take that much to partner as compared to the other investments. It gets you up and running quite quickly because you partner with people whose core competency it is to help you across your value chain. I think this knowledge transfer is really key. It does help you partner with companies who solve similar problems for your competitors. Because quite frankly, the best person to talk to is probably the same person at your competitor's company, because they understand the similar situation, but then not so sure how antitrust thinks about that, but the knowledge transfer. And even if you're looking to buy, or even if you're looking to make, partnering and looking someone over the shoulder is the best due diligence for buying. And if your partner, at the end of the day, doesn't perform at scale throughout the partnership, you know exactly what to build. Because that's the biggest problem. You don't really know what to build yet if the opportunities are uncertain. Now, what I wanted to show you is some cases that, and I've always picked an insurer and a distributor, and kind of talk through some of the examples around partnership that I personally find quite interesting. So Hellas Direct and Revolute, I think this is I'm not sure whether this product was rolled out in Cyprus or in Greece, but what they've done is Revolute has their banking account. Hellas Direct developed a contents and private liability insurance product that doesn't just sit there to return commission levels, but that is recalculated. So your premium goes down every day the more you spend on the account. It's nothing to do with underwriting or risk, but it's everything to do with what Revolut is trying to achieve, namely to make Revolut your main account and have people spend. So they're willing to pass some of that commission to their customers to create trust, etc. So this is, the product theoretically is the same. The technical integration here is quite interesting. Another case, Home2Go is it's the Skyscanner meta search engine for holiday rentals. And now usually you would go, why don't you offer your customers our luggage insurance, our trip cancellation insurance, was not really that interesting to Home2Go, because actually their problem was that they didn't even own whilst they were in the travel space and online, they didn't even own the transaction. They passed through to Airbnb and the like. So what they were looking for is a benefit for people to keep the transaction on the platform. So they gave away a guest guarantee as a benefit for people to book on the platform. Now, whether an actuary could argue, is it the most sensible insurance product? It's probably not more relevant than life insurance, but it injects trust in this marketplace. This is another one, AXA and Blabla Car. And they started out with a simple share economy. I think they started out with some accident and liability insurance when you're kind of semi-professionally driving people around and get some money. And Blabla Car now is starting their own MGA because they get access to a very interesting target audience. They get some interesting data around driving, and AXA models that insurance product around them, I think, or if they're not flexible enough, Blabla Car is just going to go to someone else who will. This is another one. This is Balois Group in Switzerland, and they started with item insurance, hundreds of different item insurances. And what they found out is, yeah, you can go direct and you go to banks, etc. But they leveraged their existing sales agents, 800, I believe, who actually didn't care around selling mobile phone insurance or hearing aid insurance or bike insurance. What they cared about is getting SME customers. What SME customers cared about is driving sales, making a little bit more money. So they used the existing infrastructure of sales agents, who then over a series, I think it was like 3 to 6 months, onboarded 700 retailers to offer insurance at the point of sale. Not very digital, not very sexy. If you look at, everything's going, it's the reverse Amazon case. But this is where people still buy today, so make that work. This is another oddball. So Cardiff is goes to BNP Paribas Group. It's a big bank insurance carrier, usually doing PPI insurance or gap insurance. Barmenia is a traditional German insurer. RCI is the bank of Renault. Now, RCI, as most car banks, they're not a traditional bank, they're really just a financing mechanism to refinance leasing on cars. So they get your deposits, give you a low interest rate, and they use that to cross-financing their low leasing rates. But they also wanted to drum up their own businesses. So in this scenario, Barmenia is underwriting a short-term car insurance product. Cardiff is paying for the technology and RCI is selling it. Pretty unusual collaboration case, but why? Cardiff wanted to leverage that relationship with RCI. They didn't have that type of license on the product. Barmenia had that license, but not the access. They weren't even competing on different routes. So all of a sudden, 2 insurance companies banding together with a big bank. This is a case from the UK that probably rolled out across Europe. Zigo, really cool Insurtech out of London, focused on the share economy. And Deliveroo is a food delivery service. So usually what they struggled with as a food delivery driver, you would get an annual policy or monthly policy, but you didn't really know how much you would actually drive for. This is a really high churn employment, right? You do it for 3 months, or you do it for 2 weeks, or you do it a little bit longer, and then just having to buy an annual insurance product with a lot of negative risk selection from an underwriting perspective was prohibitive in terms of buying cover. So that is where Zego spotted the market, and they directly integrated with Deliveroo and other platforms to do real-time pricing on this particular thing. And there's other examples around Uber and other drivers. So this is a gig economy data play. To me, this one is quite interesting that hit the news in Germany. So Element is a full stack P&C insurer in Germany who focuses on B2B2C. Volkswagen, I don't know whether they're still the largest, or Toyota, but it's one of either number 1 or 2 car manufacturers in the world, and they actually have a joint venture to sell insurance, at least in Germany, with Allianz. Now, they struck a partnership with this upcoming Insurtech to offer short-term car insurances to various touch points, probably gearing towards getting it into the car systems. Now, whether that case in and of itself is going to net massive amounts of premiums in the short term remains to be seen. But what happened is that a large distributor didn't go to their preferred partner who they even had a shared company with, but they went to an Insurtech because the way of collaboration is not just about the product, it's about the processes, and it's also about trying to make it work. One of the big problems of being successful, in order to grow, the next big thing needs to be even bigger. Otherwise, you don't get your relative growth margins. So you don't see opportunities that are dormant. I mean, if the opportunities were that obvious, that someone with a little bit of research, some PowerPoint skills, and Excel skills could model it out, people would have already done it. Because they're really, really smart people everywhere trying to figure out what works, but sometimes it takes someone who thinks about opportunities a little bit differently, and then being small, being agile, can actually be a competitive advantage. This is another case. Revolute have a bunch of cool cases in insurance, I find. So this is with Thomas Cook as the underwriter, and it's around geolocation travel insurance. So instead of only offering travel insurance on your credit card or on an annual basis or when you're actually booking, they argue because they know where they know where you are, they know when you're leaving a country, so why not offer you insurance on the go with a timer, so you cannot unfortunately go to the hospital and then buy the insurance, but they offer it to you with a timer when you touch down. Probably not working for every target audience, but for the customer segment, millennials that usually use Revolute, who travel a lot, this is an interesting touch point. For insurance, a German, an Insurtech before the name Insurtech, I think they've been around the block for 8 years. They are a digital broker. They managed to partner with Deutsche Bank, which is pretty big bank, not just in Germany, but worldwide in their retail business for 2 cases, to inject a insurance wallet, because they said, yeah, and Deutsche Bank, by the way, also partners with Zurich, so they do both. They use Zurich for proprietary products which have an advantage to sell in the banking channel, but let's say car insurance through a bank, yeah, you might need car insurance and you might keep your insurance products there, but there's really not that much of a trust brand or data play to get better car insurance. So they do both, and they're now moving into open banking, PSD2, analyzing transactions to nudge people even further. Now, most of these cases are still being developed, rolled out, but it's quite interesting that Deutsche Bank would work both with one of the largest insurance company and a startup on these things. And I think that's a mindset shift in collaboration. Work with best-in-class players. You can also strike exclusive agreements, but only if you have to hedge a lot of investment. Now, if you take out the investment, you don't really need the exclusive agreement anymore, and you can have a best-in-class point where sometimes you own the customer, sometimes you're the product provider, sometimes you have the brand, etc. So I think if connectivity is easy and getting into these relationships, the opportunity costs get lower. I think that there will be a mindset shift in terms of how to collaborate more frequently and agilely. And this is another one, Baluas and Movu. Movu is a removal company, so you move house and you get some different offers of people, you know, picking up your stuff and moving it someplace else. And they started with some removal insurance, some other spot insurance. But the interesting thing is, if you ask for a removal company, you get so much information about what you own, your inventory, a little bit more than what's usually done, which is what's your square meterage and a factor, and this is your insurance sum. They actually know exactly what you own. Now, this is quite interesting in terms of underwriting data. So what can I do, right? Or what can you do? We can have a chat, especially if you're interested which ones of these were powered by us. I think the clock started a little bit late, so I should be right on 20 minutes. Not sure if there's any... Okay, perfect. Thank you very much.